There are two types of moving averages, a simple moving average or SMA and an exponential moving average or EMA. A simple moving average is calculated by adding up n periods closing prices and then dividing by n. For example, if we want to calculate a 14 period simple moving average on a 1 hour chart, we simply add up all the closing prices for the last 14 hours and then divide them by 14. Moving averages smooth out the price curve and remove the noise from the charts to identify a downtrend or uptrend. For example, if you look at this chart right here, the normal line is not smooth as it has a lot of bumps. The second line that you see is the moving average, and you can see it traces out the chart pattern in a smooth line. So moving average is just a way to view the chart line as a smooth curve. The second type of MA, the exponential moving average, takes recent prices into calculation, unlike a simple moving average, which is susceptible to price spikes. So EMA is a more accurate version of SMA. Moving average convergence divergence or MACD is calculated by subtracting a fast short period EMA and a slow longer period EMA. When you open MACD on MetaTrader, the standard or default periods are set to 12, 26 and 9, where the MACD line is the difference between the 26 and 12 period EMA and the dotted signal line is just the 9 period EMA. On your chart, you will see a MACD or M line and a signal or S line. When the MACD M line crosses above the signal line S, this indicates a buy signal. If the M line crosses below the S line, this indicates a sell signal. Another thing you might have noticed on the chart is the histogram or H, which tells you the behavior of the MACD and signal lines. Histogram gets bigger or expands as the S and M lines get farther or diverge. It gets smaller or contracts as the S and M lines get closer or converge. At the crossover of S and M lines, the histogram is equal to 0. The average directional index or ADX measures the strength of the current trend in the market. It tells you if the market is in a strong or weak uptrend or downtrend. On your MetaTrader platform, when you go on the Insert tab, click on Indicators and then choose ADX from the list. ADX is measured through a scale of 0 to 100. A weak trend is from 0 to 25, a strong trend from 25 to 50, and a very strong trend from 50 to 100. The sub-indicators, positive DI and negative DI, measure the direction of the trend the same way ADX measures the strength of the trend. Now let's come to the ADX chart as it appears on MetaTrader. As you can see, there are three lines: the negative DI, the ADX, and the positive DI. If the negative DI is above the positive DI, then the prices are moving down or there is a downward trend. If the positive DI is above the negative DI, then the prices are moving up or there is an uptrend. Parabolic SAR signals stop-outs. That is, if you're long on a position, it tells you to sell, and if you're short on a position, it tells you to buy. In other words, it tells you when the trends are about to reverse and signals you to close your current trades. In the chart, if you see the dots appear above the candlestick, this indicates an uptrend or a buy signal. If the dots appear below the candlestick, this indicates a downtrend or a sell signal. Parabolic SAR indicates the optimal entry or exit points in the market. The Relative Strength Index or RSI identifies when the market is overbought or oversold. It's measured on a scale from 0 to 100. The market is oversold from 0 to 30, neutral from 30 to 70, and overbought from 70 to 100. RSI of 70 or above indicates that the market is overbought or overvalued, and at some time there will be a pullback. RSI of 30 or below indicates that the market is oversold or undervalued, and at some time there will be a pushback. So the rule of thumb is to buy when market oversold and sell when market overbought. The stochastic oscillator, just like the RSI, calculates when the market is overbought or oversold. There are two variables, %K and %D, on the stochastic oscillator chart. %K is the current value of the stochastic indicator, and %D is a 3-period moving average of %K. Let me make this simpler for you. The stochastic scale is from 0 to 100. So if %K on your chart is above 80, the market is overbought, and if it is below 20, the market is oversold. When %K on your chart crosses above %D, it's a buy signal. And if %K crosses below %D, it's a sell signal. Accumulation distribution index is measured by the changes in price and volume. On the chart, you can see that AD is the accumulation distribution line. If the market price is rising and AD is falling, this is a signal that the market will turn around and fall. If the market price is falling and AD is rising, this is a signal that the market will turn around and rise. If both the prices and AD are rising, this signals that the market will keep on rising. If both the prices and AD are falling, this signals that the market will keep on falling. The money flow index or MFI indicator uses both the price and volume to identify when the market is overbought or oversold. Unlike the RSI, the MFI uses both the volume and price. On your MetaTrader platform, when you open your MFI indicator, you will see a scale from 0 to 100 on your chart. If the MFI is above 80, this means the market is overbought and it's a signal to sell or go short. If the MFI is below 20, this means the market is oversold and it's a signal to buy or go long. If the prices are rising and MFI is falling, there's a chance for prices to turn and fall. However, if the prices are falling and the MFI is rising, there's a chance for prices to turn and rise. In such opposite cases, there's a high probability for the price trend to change. Bollinger Bands are a set of 3 bands that change shape as volatility of prices increases or decreases. As you can see on the chart, these 3 bands, the first one called the upper band or UB, the second one called the central band or CB, and the third one called the lower band or LB. These bands are tightening or squeezing in shape on the chart depending on the volatility of the prices. When these bands widen, this means there is high volatility in the market and the UB, CB and LB get farther from each other. This is also known as the squeeze. When these bands tighten, this means there is less volatility in the market. In other words, the UB, CB and LB get closer. When the price line is between the upper bands or CB and UB, this is a buy signal. When the price line is between the lower bands or CB and LB, this is a sell signal.